What if I told you that there was a trading technique used by this trader to turn $10,000 into $2 million in just 18 months? You might think that the trading strategy would be very advanced or complicated, but it isn't. In fact, before turning just $10,000 into $2 million, this trader developed the strategy while traveling as a professional ballroom dancer. What makes this strategy even better is that the strategy uses strict trading rules to make it easy to know when to enter into a position. The trader that we are talking about is Nicolas Darvas, a professional dancer and self-taught investor who became famous for his successful trading strategies, talked about in his book. Darvas began trading using a unique approach that he developed based on his own observations and analysis of the market. Now let's take a look at what strategy Darvas used to make millions from trading. Darvas has said that his strategy can be used on every time frame. Like nearly all trading strategies, the strategy used by Darvas mainly consisted of buying low and selling high. Because of this, the strategy can be applied to nearly any market. However, since markets such as crypto did not exist when Darvas started trading, he traded the stock market. Let's now take a look at the original strategy that was used. The original strategy used by Darvas consisted of the following: buying 52-week high breakouts whenever there is a significant increase in volume. Then we would need to wait for a pullback from the breakout. After the pullback has been completed, we can draw a box around the high and low of the price action. This is what he called the Darvas box. Then as soon as the price breaks above the box, an entry would be made. Before we apply this strategy on the current market, let's take a look at a trade that was made by Darvas with this strategy. As you can see here, we are looking at the price of Lillard. Firstly, we can see that there was a high amount of demand by the increase in volume, which can be seen at point A. This is also where the 52-week high is made. After a pullback from this 52-week high, we can draw a box around the high and low. This is what he called the Darvas box. At point B, we see a breakout out of the Darvas box. We can also see that at this point there was another spike in volume. This was the signal for Darvas to enter into the position at a price of $27.50 with 200 shares. Unfortunately, at point C his stop loss was hit at $26 when the price of the stock went back into the box. After seeing that the price bounced back to over $28, this signaled that the price was indeed going to go higher, and so he entered into the position again, buying 200 shares at $28.75. We can see this happening at point D. At point E, we see the trend continue. Because of this, Darvas bought another 400 shares at around $36. At point F, Darvas bought another 400 shares at $38. This is because the price action showed continued support even after the small drop. Finally, the stock was sold at $57 at point G. This caused for around a 60% profit. However, if we were to only count the purchase made at point D, and not the purchases made at E and F, the profit would be closer to 100%. Even though the strategy worked well when Darvas was trading with it, critics say that this was heavily due to the fact that Darvas traded with this strategy during a period when the market was heavily trending. According to critics, you could just buy at any point and make profit. However, we must also consider that when Darvas was trading, there were no such things as live charts or advanced indicators. We currently have a lot more indicators and technical analysis tools at our disposal. So let me show you an improved modern version of the Darvas box trading strategy that has a higher win rate when used in the current markets. This strategy will use indicators and will also have a fixed set of rules heavily based on the Darvas box strategy. Now let's head over to TradingView and add these indicators to the chart. But before that, if you are looking for a crypto exchange that currently has zero spot trading fees, some of the lowest fees when it comes to futures trading, and up to a $30,000 bonus, then check out the link in the description of the video to get access to all of these perks. The first indicator that we will be adding to the chart is the MAVLMW indicator. Navigate to the Indicator Search tab and search for the MAVLMW indicator. Select the indicator made by this TradingView user and add it to the chart. Now let's change the indicator settings. Select the MAVLMW indicator settings and click on the Style tab. We will be changing the second color to blue so that both colors will be the same. That was all that we needed to do. Now let's add the second indicator to the chart. Head over to the Indicator Search tab and search for the Darvas box indicator. Select the indicator made by this TradingView user and add it to the chart. The last indicator that we will be adding to the chart is the Wada Adder indicator. Search for the Wada Adder V2 indicator. Select the indicator made by Cheyenne and add it to the chart. Now let's head over to the Wada Adder indicator settings. After that, click on the style settings. We will be changing the thickness and color of the lines to make them more visible. That was all that we needed to do. Let's now take a look at how we will be using the indicators. The first indicator that we added will be used as the trend confirmation indicator so that we know what the current trend of the market is. The Darvas box indicator works by plotting lines on the previous highs and lows, which makes the indicator similar to the Donchian channels indicator. The WAE indicator also tracks the trend direction, however, this indicator also shows us the strength of a trend. Now that we know exactly how we will be using the indicators, let's take a look at when to enter into a position. Let's first take a look at the conditions that will need to be met to enter into a buy position. Firstly, the price must be trading above the Mavelim W line. This shows us that we are currently in an uptrend. Secondly, there will need to be a green bar on the WAE histogram. The bar must close above the blue cross ATR line and the white line. Thirdly, the candlestick will need to close above the upper Darvas box line. This shows us that the price is making a short-term breakout. Once the breakout occurs, we will enter into the position. We will place the stop loss at the lower Darvas box line. If the lower Darvas box line is unreasonably low, then use the recent swing low as the stop loss. For the take profit, we will target a 2 times risk to reward ratio, however we will exit with 50% of the position once we reach a 1 times risk to reward ratio. Now let's see how the trade plays out. As you can see, we exit with 50% of the position here since the first take profit target has been hit. Now we will move the stop loss to break even. Here we can see that we closed the remaining 50% of the position at the 2 times risk to reward ratio. Now let's take a look at the conditions that need to be met for a sell position. For a sell position, the following conditions will need to be met. Firstly, the price will need to be trading below the Mavelim W line, showing us that we are currently in a downtrend. Secondly, there will need to be a red bar on the WAE histogram. The bar must close above the blue cross ATR line and the white line. Thirdly, the candlestick will need to close below the Darvas box line. This shows us that there is currently a short-term breakout to the downside playing out. Based on this, we will enter into a short position. We will be placing the stop loss at the upper Darvas box line. Remember that if the upper Darvas box line is unreasonably high, then use the recent swing high as the stop loss. For the take profit, we will target a 2 times risk to reward ratio, but keep in mind that we will exit with 50% of the position once we reach a 1 times risk to reward ratio. Now let's see how the trade plays out. We will exit with 50% of the position since the first take profit target has been hit. Now we will move the stop loss to break even. Now let's see how the trade plays out. We can see here that we closed the remaining 50% of the position at the 2 times risk to reward ratio. Overall, the strategy that Darvas uses seems like a great strategy to use in trending markets. The strategy shown in the video aims to be an improved and modern version of the original Darvas box strategy, which tries to eliminate trading against the trend or when the market isn't trending at all by using the indicators we added. I hope you enjoyed the video. If you did, please leave a like and subscribe to the channel so that we can keep making these free videos.